This is not financial advice. Everything in this video is for educational purposes only. Imagine you worked hard all year. You saved $10,000. You didn't blow it on vacations or impulse purchases. You did everything right. You lived below your means. You were disciplined. You put that money in a savings account and left it alone. And then you wake up 1 year later. Your account still says $10,000, maybe $10,200 if your bank was generous with interest. Nothing was stolen. Nobody touched it. The number looks fine. But here's the thing. You're poorer than you were 12 months ago. Not because you spent anything, not because the market crashed, but because while you were sleeping, while you were being responsible and disciplined, a silent force was working against you every single day. Quietly, invisibly, without asking your permission. That force is inflation. And most people dramatically underestimate how much it's actually costing them, not just at the grocery store, not just at the gas pump, but in their savings, their future purchasing power, and their ability to retire with dignity. Today we're going to pull back the curtain on exactly how inflation works, why it's more dangerous than most people realize, and most importantly, what you can actually do about it. Here's why this matters to you directly, and I mean directly. Most personal finance conversations about inflation stop at prices go up. Eggs cost more. Gas costs more. Your Netflix subscription costs more. We all feel it. We all complain about it. And then we move on. But that surface level understanding is actually costing people, especially savers, a massive amount of money over time. Because inflation doesn't just affect what you spend, it affects what you keep. Every dollar sitting in a low-yield savings account, every dollar stuffed in a mattress, every dollar in a checking account earning 0.01% interest is losing real purchasing power every single year. Silently. Automatically. The cruel irony is that the people inflation hurts most are often the most financially responsible ones. The savers. The people who delay gratification. The people who are told, just save your money and you'll be fine. Because saving your money in cash without understanding inflation is not preserving your wealth. It's slowly surrendering it. Let's build the full picture. Let's start from the beginning. What actually is inflation? At its core, inflation is the rate at which the general price level of goods and services rises over time, which means, by definition, the purchasing power of your money falls at the same rate. Think of it like this. Imagine your dollar as a block of ice. On a cold day, low inflation, the ice melts very slowly. You barely notice. But on a hot day, high inflation, that same block of ice is shrinking in your hands faster than you can use it. The ice doesn't disappear all at once. It's gradual, it's quiet, but it's constant. And if you're not paying attention, you look down one day and realize there's a lot less left than you thought. Now the U.S. government measures inflation primarily through two tools. The Consumer Price Index, or CPI, which tracks the average price change of a basket of everyday goods and services, and the PCE, or Personal Consumption Expenditures Index, which the Federal Reserve uses as its primary inflation benchmark. The Fed's official target is 2% annual inflation. That's considered the healthy range enough to encourage spending and economic activity, not so much that it destabilizes purchasing power. But here's what 2% actually means in practice over time. At 2% annual inflation, the purchasing power of $100 today becomes roughly $82 in 10 years. In 20 years, about $67. In 30 years, the length of a typical retirement, that $100 is worth less than $55 in today's terms. And that's at the Fed's target rate. In 2022, U.S. inflation peaked at over 9%, the highest level in more than 40 years, which means for that period, the ice was melting at more than 4 times the normal speed. Here's the insight that most people miss, and this is the part that changes everything. Inflation doesn't just raise prices. It is, in effect, a tax on cash. Let me say that again because it's important. Holding cash during inflationary periods is not a neutral decision. It is an active choice to lose money. Meet Sarah and Marcus. Both are 30 years old, both have $50,000 saved. Sarah keeps her $50,000 in a traditional savings account, earning 0.5% annual interest. She feels safe, The number never goes down. She sleeps well. Marcus puts his $50,000 into a diversified portfolio. 80% broad market index funds, 20% bonds. Some years it goes up, some years it dips. It's uncomfortable sometimes, but he leaves it alone. Fast forward 30 years. Assume average inflation of 3% annually, slightly above the Fed's target, which has been the real historical average when you include higher inflation decades. Sarah's $50,000 has grown to about $60,700 nominally. Looks fine on paper, but in real purchasing power, adjusted for 3% annual inflation, that $60,700 is worth only about $25,000 in today's dollars. She has effectively lost half her purchasing power over 30 years while thinking she was being safe. Marcus's portfolio, assuming a conservative 7% average annual return after inflation adjustment, a historically reasonable figure for a diversified index portfolio, has grown to approximately $380,000 in real terms. Same starting point, 30 years apart, $25,000 versus $380,000. That is the silent theft of inflation compounded over time. And that gap, that staggering, almost unbelievable gap, is created not by anything dramatic, not by a market crash, not by bad luck, simply by the quiet, daily erosion of purchasing power against a stagnant cash position. Inflation doesn't rob you in one night. It pickpockets you every single day. Let's ground this in data. According to the Bureau of Labor Statistics, the U.S. dollar has lost approximately 97% of its purchasing power since 1913, the year the Federal Reserve was established. What cost $1 in 1913 costs roughly $30 today. That's not a crisis. That's just a century of quiet, compounding inflation doing its work. J.P. Morgan Asset Management's annual guide to the markets consistently shows that over any rolling 2-0-year period in modern U.S. history, a diversified portfolio of stocks and bonds has never produced a negative real return, meaning, over long enough time horizons, investing has historically beaten inflation, cash has not. A 2023 analysis by Charles Schwab found that investors who held excessive cash positions, defined as more than 20% of their investable assets in cash or cash equivalents, significantly underperformed diversified portfolios over 1-0-year periods, even when accounting for market volatility and drawdowns. And perhaps most striking, the Federal Reserve's own data shows that the bottom 50% of American households by wealth hold a disproportionately large share of their assets in cash and low-yield deposit accounts, meaning inflation systematically hits lower and middle-income savers hardest, not because they made bad investments, but because they made no investment at all. This is why understanding inflation isn't just an economics lesson. It's a wealth equity issue. Now, and this is important, I'm not telling you to never hold cash. That would be irresponsible advice and, frankly, dangerous. Cash has a role, a critical one. Your emergency fund 3 to 6 months of essential expenses should absolutely be in cash or a high-yield savings account. Liquidity matters. When your car breaks down or you lose your job, you cannot sell index fund shares at a market dip to cover rent. Cash provides the stability that allows you to stay invested through volatility without being forced to sell. The question is never cash versus investing. The question is, how much cash is the right amount, and what do you do with everything beyond that? There's also a nuance around which cash equivalent tools you use. In a high interest rate environment like 2023 and 2024 high-yield savings accounts, money market funds, and treasury bills were offering 4.5% to 5.5% annual yields. That's a meaningful partial hedge against inflation. Not perfect, but significantly better than a traditional savings account at 0.01%. So cash is not monolithic. Where you park your cash matters enormously. One more thing. Deflation falling prices sounds appealing, but carries its own serious economic risks. Japan's lost decade in the 1990s is the classic case study of what sustained deflation does to an economy. A moderate, predictable level of inflation is actually a feature of a functioning economy, not a bug. The problem isn't inflation existing. The problem is holding assets that don't keep pace with it. So what do you actually do with this? Step 1. Know your real return, not your nominal return. If your savings account pays 1% interest and inflation is running at 3%, your real return is negative 2%. Always calculate purchasing power, not just account balance. The number going up doesn't mean your wealth is growing. Step 2. Build your cash floor, then invest above it. 3 to 6 months of expenses in a high-yield savings account or money market fund. That's your floor. Everything above that floor should be working harder than inflation, which historically means broad market index funds over long time horizons. Step 3. Use inflation-resistant assets intentionally. Beyond stocks, there are assets specifically designed to hedge inflation. Treasury inflation-protected securities, or TIPS, Series I savings bonds, real estate, commodities. These aren't for everyone, and they come with their own trade-offs. But they exist precisely because the problem you're facing is not new. Step 4. Increase your income over time. This one sounds obvious but gets overlooked. Inflation erodes fixed incomes most brutally. If your salary doesn't grow, at least in line with inflation over your career, you are effectively receiving a pay cut every year. Investing in skills, credentials, and earning power is one of the most direct inflation hedges available to anyone. Step 5. Don't let perfect be the enemy of good. You don't need a sophisticated portfolio. You don't need to understand macroeconomics deeply. A simple 3-fund portfolio, U.S. Total Market Index, International Index, Bond Index, has historically outpaced inflation over any 2-0-year window in modern U.S. history. Start simple. Start now. The enemy of your purchasing power isn't complexity, it's inaction. The money sitting still in your account isn't resting, it's shrinking. Every day you delay putting it to work against inflation is a day the ice melts a little more. That's the full picture of inflation, what it actually is, how it quietly erodes your purchasing power year after year, and the specific steps you can take to make sure your money is working harder than it's losing value. If this reframed how you think about your savings account or made you reconsider how much cash you're holding right now, consider sharing this with someone who needs to hear it. If you enjoyed the video, please like and subscribe. It really does help this channel reach more people who are trying to build real financial knowledge from the ground up. And if you want to go deeper on how to actually build a simple inflation-beating portfolio, the next video is right here. I'll see you there.